So guys, we're going to talk about the accounting cycle, whereby a transaction takes place. We're going to generalize that transaction and prepare the ledger accounts. But the most important part about accounting, if you see yourself preparing the ledger accounts, but they don't apply to this thing, to what you call the accounting equation, it means you're going to be wrong. Let's take for an example, and adjustments come to you, say they have what we call a cash sales 400,000. In the accounting cycle, this is the first step. Transaction took place. You must first try to generalize that sentence. Let's generalize it. The two accounts that are going to be affected because of cash, you already going to have bank. Let's make it short. You first want to have bank. The second account is this one, sales. You have the sales account. So the question is, which one is a credit, which one is going to be a debit? Whenever you're receiving cash because of sales, and I will learn something about the assets. Going to the assets, all assets. These are the assets. This is an asset, a ledger account for assets. All of them, they increase on the debit side, they decrease on the credit side. The owner's equity accounts, they increase on the credit side, they decrease on the debit side. Lastly, the liability accounts, they decrease on the debit side, they increase on the credit side. So we're going to look at this transaction. You are receiving cash automatically. It's a plus, which means, and we must not forget the size. This is a debit side and the credit side here. When you are receiving cash, you come here to the assets. They must increase. They increase where? They increase on the debit side, which means you're going to have 100,000 here, firstly. Automatically, the second account has to be a credit so that plus and minus becomes zero. Sales account is going to come here. And let's not forget, sales is an income account. All incomes increases on the credit side of the owner's equities. And expenses are going to come here. Because like here we have incomes. Here we have expenses. Yeah. Okay. And the incomes, the accounts like whenever the owner is coming to contribute something to capital account, give sales, give profit on sale of an asset, and any other income like discount received, as long as we see you are receiving something, donations received and whatsoever. So I can just write all of them. So we're going to look at this transaction. We post from general entries to ledger accounts. Let's open two ledger accounts for this transaction. The first ledger account, we check this account, this two. The first one, let's say, is bank. Sorry guys, my handwriting is bad sometimes. And also, the most important part, make it a point when you prepare a ledger account, know where is your positive side and your negative side. On all assets, no matter get vehicle, get land and building, get equipment, get bank, get trading stock, whatsoever, plus on the debit side, always. Don't ever make a mistake. So this means you have a plus, debit, and then credit. Let's pay attention on this one. When you're preparing a ledger account, you can't write any account name by the name of the ledger account that you're preparing. Let's assume now we're preparing the bank account. You can't have anything here saying bank. Let's check. You debited 100,000. You're going to record the amount here, 100,000. The question is, which account contains of this 100,000? Why are you receiving that amount of money? You made what? Sales. Which means the account here is sales. Go into the second ledger account, you're going to have sales. The sales account. Not forgetting with the sales is an owner's equity account. plus on the debit side minus on the debit side. There they are. And sales is an income account. Automatically, you're gonna have, you credited it again. Let's check the signs. You credited sales in here also. You must also credit it. The same thing applies to the bank. On the ledger account of bank, always whenever you're preparing the journal entries, if you see yourself debiting an account, no matter what you get ready stock or whatsoever, if they say prepare the general ledgers, you debited the balance, you can't credit it. You have to debit it again in that specific ledger account, which is why I came here, I debited 100,000 by the account of sales. So coming here, let's check something. We have sales here with an amount of 100,000. This amount has to have a debit balance somewhere. We come here, we're gonna have, oh sorry, it is a debit balance, it must have a credit balance somewhere. We come here, we're gonna write the amount 100,000. Why are we recording this amount? This amount of 100,000 comes from where? The ledger account of bank. Automatically you must have a bank account here. Now let's test if as accounting equation fits. We have assets is the bank. By the way, I said the assets give bank account, give trading stock. This one that I'm talking about now is what do you call the current assets. The issue here, they are assets. All assets increase on the debit side again. Okay, let's check. Under assets, we have bank. This thing is an asset. Not forgetting this one is an owner's equity account. Account equation says that you must say assets is equals to owner's equity plus liabilities. Now you know the balance of an asset is this bank. You're gonna have 100,000 is equals to the 100,000 of the owner's equity. And let's check the signs. It is positive. It is positive. You're gonna have. There is no way you can have a debit and a debit. Whenever you're preparing the ledger accounts, you can't have a debit balance and a debit balance. No way. To check or everything that you've prepared is correct, you must have a debit somewhere and a credit somewhere. Once you see yourself having a debit and a debit, it will clash. Let's check. You have the owner's equity. It's a positive sign level, which means you're gonna just write it as 100,000 plus on this transaction there is no liability. By the way, the business made cash sales for 100,000. They are receiving money. They are not paying anything, or they are not owing anyone a cent there on that transaction, which means we don't have any liability. So you can now see what 100,000 is equals to 100,000. Account equation of no balance. Okay, let's take for an example. We have another transaction stating what they are making cash. Let's say the business is purchasing something, because if I'm looking for a liability, it must be a business owing someone. Let's assume I will say the business is purchasing inventory on cash and on credit at the same time. Popular something, we're talking about the business now. Oh, sorry for wiping the most important parts. Assets plus minus owner's equities plus minus. Let's assume now, the business is purchasing inventory or trading stock on cash and on credit. Let's assume the transaction is like this. The entity purchased stock with 100,000 on cash. And purchased again inventory with 60,000 on So firstly, we have to check how many adjustments do we have here. We will generalize it first, and then do the general ledgers accounts after. Let's check. Stock and inventory, they mean the same thing. No paper must tell you. If you see stock or you see trading stock, you see merchandise, they are all related to the ledger account of inventory. Let's start by generalizing it. On this transition, let's check. We have stock, stock inventory first account. Hurry up, but cash. Cash in bank, like I said. Business issue makachele ka a business operates in the means of making a profit. When we see stock, we see cash, two accounts already. Bank, inventory, and again they say they purchase again on credit, meaning we have the account called creditors control, which is a liability. So on this transaction, we have assets and liability, but the issue comes on the sides here. Like I said, assets, all assets increases on the debit side, they decrease on the credit side. You will see that when we prepare the ledger accounts. Let's first analyze this transaction. Okay, the first account, we're gonna have inventory. Inventory is an asset. I said all assets, whatever they're coming in the business. Check the side. All assets increases on the debit side, which means the amount that we're gonna record for inventory has to be debited. And we have two amounts in relation to inventory. First term stock, second term inventory, but they all mean the same thing. Which means for inventory account, you're gonna open a bracket here. You have 100,000 inventory that you purchased with cash. This is the inventory that you purchased with cash. This is 100,000. And again, you purchased another inventory on the same transaction worth 60,000 on credit, which means you're gonna add 60,000 here. And let's not forget, this amount is debited. We're gonna have 160,000 on the debit side. Now, as I said before, your debit must be equal to your credit. When you generalize, let's test something here. Second account, you're gonna have bank. Not forgetting your bank is an asset. When they receive cash on a bank account, they come here. When they pay, they come on the credit side. And check at the side. It's a credit side and it's a negative. You're gonna have the first transaction is gonna be out. You have this amount of 100,000, which you purchased stock with, and it was on cash. On the bank account, you're gonna credit 100,000 because of you are paying as a business. You are not receiving money. Again, the last account that must be affected. We purchased inventory again on credit, which means we're gonna have what we call the creditors control. Let's remember the person who's purchasing here is the business. We're gonna have the creditors control with an amount of 60,000. Now let's check. 100,000 plus 60,000, 160,000. Debit and credit have balanced. Now let's test this thing on the ledger accounts. Let's start with the inventory. No, let me start with the bank account one. We're gonna have the bank account. We're gonna have the creditors control account. I'm starting with these two on the credit side. By the way, they have the credit balances, but here the account that must be affected here is why are you recording the amount on credit? For the first one, for the bank account, you recorded 100,000 on the credit side. Reason being you purchased what? Inventory. Coming to the creditors control account, same story. Let's not forget we have a plus, we have a minus, we have a minus, we have a plus. Next. Creditors control, you credited it here on the general channel by an amount of 60,000. Now we want to know why did you credit this balance here? Because you purchased what? inventory. The same thing, inventory here. Now the last ledger accounts, we're gonna go to the inventory account. On the inventory account, let's not forget you debited an amount of 160 here. We wanna see what was this 160 built up with. And again, let's not forget, wherever you see a credit, you must have a debit balance somewhere. Which means, let me talk about this one on the bank account first. You have an account here by the name of inventory. Yeah. This credit balance, its debit balance has to be in the inventory account by the name of the original account, which is this one. You're gonna write bank here with an amount of 100,000, and again you have a credit balance of creditors control, but the account here is inventory. Yeah. So coming to the inventory account, you see you have the account of inventory. You have to go to inventory on the debit side because of it's on the credit side. The same balance here, 60,000. Why are you recording 60,000? Because of it comes from creditors control. Now you can see how this 160,000 was built up. If you add the two, you're gonna get 160,000. Now the accounting equation is still the same. You have assets is equals to owner's equity plus liabilities. Let's check. On the assets, you don't have a positive number. You have a negative 100,000. Sorry, you have a negative 100,000. Going to the owner's equity account, you don't have any owner's equity here. This one is 0. You have a liability of 60,000. You have a liability of 60,000. Not forgetting more, you had two assets. You had a bank account and you also have an inventory account. They are all assets, and this one is positive. Let's not forget, where is it? This one is positive. The balances here are positive. 160,000 is a positive number. So if you say 160,000 minus 100,000, you're gonna get the 60,000 of the liability, which means now assets is equals to liabilities. We don't have any owner's equities. So thank you guys for watching the video, and please don't forget to subscribe. I appreciate you so much. Thank you.